Welcome back to the Profitability Project. Today is a special day because of a couple things. One, it's just Kenzie and I, which is kind of unique and fun in its own way. We miss the other girls, of course, but it's kind of nice to come back to the roots of it all. Reason number two, and I feel like I can say this because she's announced it on social media, we've added another baby to our litter of children. Luckily, and probably most excitingly, it didn't have to come from either of us, and I think that's
Yeah.
the best.
And it will never again.
Yeah, and then never closed up shop with these two, so super happy that we can still add babies to the group. And if you don't know what I'm talking about, no, we don't have sister wives. That's the wrong type of Mormonism. We do have team members. In fact, I was gonna count. I gotta think about this because I need to go through and count again. I have 3, you have 3, Becca now has 3. Who's next? Gracie has
Althea has
0, Althea has 2. I'm an accountant, I can count. We're at 11.
Davy has
3. Corinne has 2. Lindsay has 3. We're at 19.
and Madeline has 1.
Madeline has 1. 20 children.
Yeah, that's a
Oh
lot.
my
That's a lot.
gosh, it's a freaking factory up in here. That's crazy, but also super exciting and fun. That has always been one of the metrics that I feel like we've measured our growth by, is how many children are among us, because working moms, it's life. So anyways, super exciting. Becca has had a baby. And then the last piece of exciting news is that we have one new listener that I'm aware of, which is so cool because as everyone knows, the listeners that I know of amount to exactly my mother. Sometimes I actually, I don't even know if we can count her. I don't think she's an avid listener. We'll count her. Allison, who's been an OG from the start and we love, shout out. And Davy, who now works for us. So does that even count? Not sure. But I met a new friend. I'm such a mom. A new friend named Sharon, and she found us from the podcast. And she lives in Florida across the country, and I'm still riding that high. It's been a few weeks, but shout out Sharon if you're listening. XOXO. Thanks, girl, for being one of really 2 listeners of this podcast. It's great. So exciting stuff over here. We're also deep into summer, and so our whole team is losing their minds with having their kids home. It's a great time. Becca's on maternity leave. We're just slightly pulling our hair out. It's all good. Any updates I'm missing, Kenzie? What else? What else is going on around here?
We officially brought on a CPA.
Flu.
I don't think since our last podcast we had. And so that is super fun and exciting and adds another level of what we can offer and do for our clients.
So true. And Madeline, I can't wait for our audience of 3. Just everyone to meet Madeline. She is genuinely the cutest ever. Additionally, I didn't tell you this, Kenzie, but I was talking to a potential client last week, and he's in real estate, and Madeline, geez Louise, has some real estate background. And so he was kind of asking me about her background. Yeah, Madeline is no freaking joke. When I brought up her resume and was doing a little more research on the companies she was working for and the scope of work that she was handling, yeah, she's a baddie. And how we landed her, I will never understand, but we're gonna not jinx it and be grateful that she's here. So get pumped. We'll have her on the pod soon enough, I'm sure.
Yes.
Yeah, that's a big one. What else? Anything else?
I think so.
Okay, cool. Well, good times over here. Definitely enjoying the summer as crazy as it is. But today we are going to be talking about halftime, as we have been talking about all of June. It is crazy that we are halfway through 2026. It sneaks up on me every year because I think with tax season, it's just like get through it, get through it, get through it. And then there's the come down in May, and then all of a sudden it's June and we're halfway through the year and it sneaks up. But we want to talk about June and how it is halftime, and really as a business owner, what that means for you and what you should be doing as a business owner for your finances at June. This is really not a checkpoint that we want business owners to stress about. And we'll talk about that a little bit. But again, everything financial, and you know how I feel about emotions and finance and all the things. We don't need to get rid of the emotion. But again, just reframing if you're behind, that this is just information, it's just a checkpoint to use rather than something to get upset about or frustrated with. I feel like most business owners get to June and either they feel fine or they are like, crap, how are we halfway through the year? I'm failing. Or they're completely not paying attention because, like a lot of us, they're in the thick of it and they don't even have time enough to get their head up to be like, holy crap, we're halfway through the year. Let me check on where I'm at. So, we're going to talk about how you can base that off of actual data and how that will actually save you a lot of time, energy, and heartache. And by the end, you will have 5 specific numbers to pull and you'll know exactly what to do with them.
Yep. I'm super excited about this topic because as a basketball girly, I played and coached, and it's like just fun because like I can like pull analogies, but like in basketball, halftime is the time where like you regroup, you look at how your first quarter went. Halftime is the time where you kind of regroup and you sit down with your teammates and you look and you're like, okay, what do we need to do better? Let's look at our stats from the first half. Let's do all of these things. We need to rebound better. We need to take better shots or like whatever it is. Maybe you're behind and you're like, okay, if we want to win this game, we've got to do X, Y, and Z. Or maybe if you're ahead, you're like, okay, if we want to keep playing how we have these are the things we need to continue doing and these are the things we need to do better. So I think that this is a really fun topic and a fun way to like pull in something that is very close to like my heart and things that I love. And so, yeah, I just think that like halftime is a really great time to really sit down and review what do I need to do better? What do I need to continue doing? And kind of basically regroup for the second half.
And I love that you bring that in because we're actually a lot of us are sports girlies, whether we played or like I also played basketball, but Mark's obviously a coach, my husband, and so sports is our life. And I love that analogy because I don't know a single sports team that at halftime, if they're behind, goes, I don't know, man, I don't know, or
Yeah.
at halftime, they're not looking at the score and they're like, I don't know, feels like things are going well. No, like the whole strategy going into the locker room at halftime is based on what the score is. They're either going to tell you how to come back from a deficit or they're going to tell you how to
Yeah.
keep your lead. And
Yeah.
both require knowing exactly what the score is. So I love that analogy. And I think we should bring that in quite a bit in this episode because if you're behind again, that just means you're setting yourself up for a sick Cinderella story. Like, and we love a good game that comes, has a comeback. So it it doesn't mean anything. It's only halftime. So
Yeah.
let's
Yep.
just
And not only like the scoreboard, but you're also looking at your stats. How are your rebounds? I'm going to use basketball, but like obviously
I
with
love it. Yeah.
other ones you can basketball's kind of a good one to,
Yeah.
mirror with accounting, but
Yes.
you are looking at the scoreboard, which, could be your net profit, could be your gross profit, could be a couple different things depending on your business. But then that's not the only thing you're looking at, right? Like you're looking at your stats for rebounding, you're looking at your shooting percentages, you're looking at how many turnovers have we had? Like what's the rate of like turnovers, points per turnover, If we have 10 turnovers and they're scoring 20 points,
Right.
that's a problem.
That's where we need
So
to start. Yes.
exactly. So while the scoreboard is obviously important and that's what tells you who wins and who doesn't, there's also a lot of other numbers that you can look at that will also help in making that scoreboard look better for you.
Yes, and I love that because we're going to tell you the 5 stats to look at, and just like Kenzie mentioned, if turnovers are the thing that are leading to the score, that's where you're going to focus. There are only really 4 places that a leak can be happening, and we're going to talk about the different steps. If you've been following along with our content, we've talked about the 3 steps to kind of like figure out where the leak is and what to do about it. There's really only 4 places it can be in finance. So, unlike a lot of sports, it could be turnovers, it could be basketball basketball, I'm an idiot. It could be turnovers, it could be rebounds, it could be any number of things. There's probably a lot of things that could be contributing to the score. In accounting and with finance, I'm gonna tell you there's probably only 3, and it's probably one or a combination of those 3, which is good news because 3 problems are easy to fix, right?
Yep.
Like, that's
Yep.
doable. So, yeah, I love this analogy. I didn't even think of that, so I'm glad you brought that in because I think that's easily digestible for business owners. And again, it takes the heat off of sitting down and recognizing that maybe you're behind in finance for whatever reason that makes us as business owners. Actually, I have a lot of reasons. but that's a different episode. But as entrepreneurs, we're like, crap, and we just want to throw in the towel. But
Yeah.
when you think about it through the lens of like a game, no team would ever do that. You would never do that. Even in the bottom of the ninth, switching sports analogies here, you would never totally give up on it
Yep.
until the
Crazy.
last runner strikes out, right? So
Yeah.
I was reading a baseball book last night, so sports.
I'm reading the basketball one, so
Shout out Windy City series. And now you know too much about me, but I finished the spinoff last night, so I'm officially it was yeah, okay, it's fine.
behind. But I did read on our car drive, so I read for like 3 straight hours, so I'm getting
Incredible. I'm so excited to discuss. So great. Okay, so here's why okay, I actually want to take this analogy just one step further too, because in business there is not a halftime moment. In sports, for the most part, I don't know about baseball because baseball's not my jam, but basketball and football at least, which I know very well, there is a dedicated time for regrouping, sitting down in the locker room with just the team and adjusting strategy. And I'm going to make a claim today that June should be dedicated halftime month for all business owners. That is the month that you don't do anything except regroup, see where you're at, and adjust your strategy. Why are we not doing that? Why have we not thought of that before? I don't know. Maybe someone knows that they should be doing that and I'm just behind, but I've never
I
thought
think
about it like that. But you
yeah.
would never skip halftime locker room chat
No, you
in a
wouldn't.
game.
No. And I think too, I think it's really easy to get in the groove of things and just be like, go, 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 go as a business owner. And you're
Yes.
like, I gotta do the next thing. I gotta do the next thing. I gotta do the next thing. And so I think sometimes it's hard to like remember, like, okay, wait, I need to like take a step back and like do a full review. And June is a really good time to do that because you have 6 months of financials under your belt. Really, I guess it's technically if you do the beginning of
Right.
June, it's
Sure.
5. But, but
But you have 6 months of
you
game
have
time left
yes, you
to
have 6
fix it.
months, really 7-ish,
Yes.
it's just
Yes.
depending, but, you have 5 months of solid financials that you can now look at and make good decisions moving forward. So you can
Yes.
look at the numbers I'm not gonna spill the numbers that we're gonna have you look at yet, but the numbers that we're about to tell you about, you have 5 good numbers to look at and 5 months worth of those numbers to now make good decisions. And, I think obviously we preach you should be looking at your numbers monthly, but I think halftime is a really good time to really regroup and be like, okay, this is now the time where I have to like make a big game time decision. If I'm going to hit my goals, if I'm going to hit X, Y, and Z, these numbers that we're about to tell you about, I have to make big moves or I have to make big adjustments. And that is, you have to dedicate time to that or your business isn't going to do what it needs to do. You're not going to hit those goals. You're not going to like do all of the things that you want to do. And maybe sometimes halftime will be a time where you go, okay, I'm doing too much. I need to back up and get back to the basics, right? I think a lot of times in basketball, there's been many a time where we've gone into the locker room and we're like, we're trying to do too much.
Yes.
Get back to the basics. Box
Yes.
out, get a rebound, take good shots, use your teammates. Like sometimes it's like we're trying to do too much because we're too chaotic and we're not working together as a team and we back up and we go back to the basics. That's what
Totally.
we, you know. And so I think that, like you said, like if you don't have that dedicated time to do that, to sit down and have a halftime discussion, what are we doing?
You'll continue on the same path, right?
Yep.
For good or bad.
Yep.
And I suppose that there are like staff meetings and quarterly meetings. I know some businesses do this, but I love the idea of particularly through a finance lens, spending June looking at where you are and where you want to go, and just forcing yourself to come up out of the weeds and do that. I think that's the hardest part, like you said, is just not getting sucked into the day to day and being like, it's June. I have to find time to look at where we actually are and then strategize what I'm going to do to fix it. The other thing I love, and again from a tax perspective, when people come to us in January and they're like, "Hey, I'm worried my tax bill is going to be really high." I'm like, "That's really unfortunate for you. Like it's the
Just
year's over. Game's over, bro."
yep.
Like
Yep. The
buzzer
numbers
has
are on the
sounded.
board.
Yeah, and I mean, obviously, there's a few things that we can do from a tax perspective. It's not all lost, but the majority of the work that we can do happens during the year. And so the idea of like, hey, even if things are going really well and you're super profitable, like I was in somebody's books yesterday and I immediately looked at their books and slacked Madeline and I'm like, they need a tax strategy call right now because they're making too much money.
Yep, absolutely.
I'm like, is
Absolutely.
there any way we can be strategic around this profit so that they don't, pay, I don't know, 100 grand to the IRS? And again, I want to keep everything above board and we're not advising against anything, but I'm like, we just need to be strategic. And so there's a million levers we can pull again at this halftime moment. And one of the beautiful things about working with our team is part of our job is looking at these numbers for you and we will strategize in the locker room you know, behind the scenes. But anyways, I just think that taking that time is going to be really beneficial. So let's talk about now you've decided you're going to take the time in June. Let's talk about what you're actually going to do when you take that time. So the problem comes from, I guess, that in January everybody sets goals, but then there's not really a mid-year check-in and growth can eat up cash very quickly and it can eat up cash before it generates cash. So there can be a cash problem. We're experiencing this with one of our clients right now, where she scaled really a ton in Q1 and Q2. And then she called me yesterday and was like, where is the money? And I'm like, remember how you had to invest in all this inventory and like it feels tight. And if you use credit cards, we're lagging and there's a million factors, right? So June is kind of when those things start to show up, when all the January plans start to show up. Again, growth or not growth, a little bit. Good news, bad news, right? It doesn't matter. June is when you start to feel it. And you definitely don't want to find out in October that something went sideways in May. That's a problem. Um, and then again, if you're profitable, June 15th, 2 days ago, is when estimated taxes are due. So if you've been setting money aside, now's the time to know whether you're going to have to pay the IRS not in December because you don't want penalties and interest on that. Um, so that's kind of the problem. Anyways, I feel like we've beat that horse to death. So now that you're, let's say, in the locker room, these are the 5 numbers that I want you to pull and what to do about them. The first one is going to be your revenue versus what you actually wanted to make, which feels very obvious. And I talk a lot about how revenue doesn't matter. And in a lot of ways, it doesn't. But in a lot of ways, you can't have profit without revenue. And we need to figure out if the growth that you planned for is happening or not. So pull your actual revenue year to date and compare it to where you plan to be. And this isn't just like, hey, are we up or are we down from our goal? I want to actually understand the pace of your revenue. Are you on track to hit your annual numbers at the rate that you're growing, or are you not? Revenue can be up and you can still be behind from your goal if you front loaded expectations. Or accounting is a really great example where the front half of the year comes with a lot more revenue typically because of tax season than the back half of the year. So even if, Q1 looked really, really great, that doesn't mean Q4 is going to sustain that same growth.
Or, any type of seasonal work. If you have, a food truck that does more work and more opportunities in like the summer and the warmer months, like
Right.
revenue is going to look really, really great during those months. And then in the winter, it's going to be not a great number
Sad.
because of
Yes. Yes. And product based businesses, e-com, Q4 is obviously going to bring in a lot of your sales, but it's not going to bring in all your sales. So are you on track? And if I'll just say this, if you are in e-com or CPG, you better be having a halftime report because Q4, like this is when you plan Q4. This is when you execute on Q4. All your email marketing, all of your strategies, what products are you launching? When are you launching them? How are you going to pay for the inventory? That's a today conversation. So
Yep. Yep.
that's super important for you guys. Okay, number 2. So number 1 is revenue. Number 2 is gross profit margin. If you don't know what gross profit margin is, you're going to take your revenue and then your cost of goods sold. If you're, again, product based, that's going to be your inventory, the actual cost of buying or making the product that you're selling. If you're in service based, typically this is your payroll for the people that are actually executing on the work. So revenue minus cost of goods or cost of service, what's left over is your gross profit. That percentage is your gross profit margin. What percent of revenue is that number? Okay. Revenue is vanity. Profit is sanity. We say that a lot around here. If your cost of goods or cost of delivery has crept up, again, this is something that we just discovered with one of our clients. The cost of delivery was like through the roof in May. We want to know that now, not in December. Your gross profit margin is going to tell you that before your bank account ever will. So that's why gross profit margin matters. What a healthy margin looks like is going to vary by industry. So I'm not going to throw out a number of what that should be. If you want to know for your industry, shoot me a DM on Instagram. I'll tell you. But the point is that that you know what your number is and whether or not it's moving. It really shouldn't be moving. If it is moving, you're either tracking COGS incorrectly, or your pricing is inconsistent, or something like shipping is variable, and that's
Right,
a problem.
right.
Yes. So when I look at gross profit margin for my clients, this is where I'm determining if they need to increase prices, if their vendors' costs have changed, if scope creep is showing up. That's a big one for service-based business, whether or not you're paying somebody more hours for the same amount of revenue, that's a big deal. So those are kind of the decisions I make based off of gross profit. And Kenzie, talk to me a little bit about like when we've seen this for our business, scope creep, and like how that affected our financials.
Yeah. I we have we've talked about this a little bit, but there have been times very early on in our business when we were like, if the client asked us to do something, even if it was like out of our scope, part of the problem was we didn't know what our scope was. The other part of the problem was we were people pleasers and we're like, yeah, we'll do whatever you want. We need your business. So
Right.
like on us, right? And so we were spending more and more and more and more hours with the client and for the client without ever changing their price. And that will happen occasionally now. We are a lot better now today than we were 5 years ago of like setting a boundary and being like, actually, that's out of our scope. We can definitely add that on, but it is going to cost you more because at the end of the day, we have to make payroll and we have to pay our people for the work that they do. And if our people are working 40 hours on a client and that client's only paying us for 20, we have to come up with those 20 hours of pay somewhere.
Totally.
And guess where it comes from? Our
Yeah.
gross profit margin. And then what does our number look like? Terrible, right?
Very well.
So those are things that can absolutely happen. The other thing is like with on a product-based business, I mean, prices are constantly changing, right? And it just kind of depends on where you're getting your product, who you're getting your product from, who's shipping it, how are they shipping it? Do you have to pay people to do that? Like what all of that entails. And so you have to be watching that profit margin to see when that number all of a sudden goes way up or goes way down, right? And halftime is probably, if I'm being honest, a little late to be looking at that. You really should be looking at that month over month and comparing it because then you're going to catch it fast. So like in January, if my I'm just going to throw out a number. These are just numbers for the sakes of numbers, right? So like if your gross profit margin is really high in January, but then all of a sudden in February it drops really low, that would be possibly concerning, right? Or vice versa. And so those are things that you have to be evaluating because like I said, that gross profit margin could go like this. We don't want it to, and we want to be on top of that. But if it is, we want to catch that because the bank is not going to tell us that. We're going to be out of money before we realize that it was even an issue. And then we're going to be in a really big hole.
Yes. Right.
So we want to be looking at that margin month over month to catch when those numbers change. You know, as we review your books and look at them, that is a number that we look at consistently. And if that number changes for good or bad, it's automatically like a red flag that we look at to make sure that everything was accurate because we strive to keep that number the same. But like obviously it could change. And I think a little bit of a variable isn't horrible, but if it drastically changes one way or the other, we want to be on top of that. And you as a business owner should be on top of that because you want to make sure that we are making adjustments. Do we need to find a new manufacturer? Do we need to like why was our shipping cost? Did we have like, way more sales? But again, if you have way more sales, that those numbers should
Margin's the
kind
same.
of follow the same. So if we had like way more sales and then our, you know, shipping costs or COGS was like way, way higher, it's like that didn't quite move like we expected it to.
I think that's important. Like you said, checking it month over month, but the nice thing, just the same as you would, again, let's pull the sports analogy, the same way you're looking at stats throughout the entire game. The nice thing is that June is a dedicated time to like take a break, sit down and look at the pattern of it and then say, okay, what are we going to fix? What do we need to change? And of course, you can change small things throughout the game and you absolutely should, but it's nice to get your head above the water for a little bit, be able to see a set of patterns and also then be like, okay, now I have 2 seconds dedicated to fixing this. What are we actually going to do? I'll give you a good example. So this client that called me yesterday kind of, she was like stressed about her margins and she's like, I know you keep saying my margins are really great, but like I just got this bill from my 3PL, which if you're not in product, that's basically the warehouse that's distributing the product, and they do more than just shipping. It's kind of like a full suite of service, but the big thing is that they're shipping the product out. And she's like, I got this huge bill for the shipping from them. And I'm so confused why we're paying this much in shipping when, you know, it really doesn't make sense. And she's like, can you look at my margins and make sure that we're on track? And I'm like, yes. The good news is I don't even have to look because I know your margins like the back of my freaking hand because I've been looking all year. But I'm like, it's good to know and like specifically look at the invoice from the 3PL and see kind of what's changing to see if they are going up or down. But then I also was like, the good news is when you work with us, I have 4 other people who use 4 different 3PLs and I can see what they're charging because the answer she got from her 3PL was like, well, oil prices. So like the cost of shipping, you know, whatever, not a lot we can do. And I'm like, I can actually go fact check that and see if that's actually true. And so we were able to do that. And I'm like, yeah, your margin's still really, really healthy. I'm really not concerned. And she's like, if you're not concerned, I'm not concerned. And I kind of explained the difference of, you know, margin versus cash, which we'll get into in a second. But it was just nice to be able to be like, we've got this covered. If as a business owner, you don't know those numbers, it would be so easy to like literally run out of cash like that or get robbed blind by a 3PL that says like, oh, that's just the way of the world, you know, like it is what it is. Or no, if you need to raise your prices because that's the way of the world, you know?
Right. Hmm.
So anyways, it's just it's important to have that dedicated time. Okay, so now we have revenue and we have gross profit margin. Number 3 is cash on hand versus 8 weeks of expenses. I did have somebody ask me on Instagram the other day what the first number you should look at as a business owner is if you have to check numbers every week. And I said, bank balance because cash is king, which felt like a betrayal of everything I believe in because I'm like, bank balance tells you nothing. You know, there's expenses coming in, there's money coming in, expenses going out all the time. You really don't know what you like. That doesn't encompass everything. But if you had to check something in the middle of the game and you only have one time, cash is king, cash on hand. That's not what I'm talking about. I'm talking now about your halftime strategy. And because of that, I'm now moving it to the third number you're going to check. And I'm also adding this caveat of versus 8 weeks of expenses. This trips up a lot of business owners because I would say, and this is a total guess, but of the businesses that I work with, I would say 90% of them do not have enough cash in the bank to cover 8 weeks of expenses. In the history of my career, I would say 90%. There, and the ones that do have worked their butts off to get there.
Yes.
And
Yeah.
it's taken years.
Yeah.
So if you're behind on this, don't stress too much, but I do want you to put this in the docket for something you're working towards because this is how you're going to save your business during crunch time when things get really crazy. So the benchmark is, can you cover 8 weeks of operating expenses with with the cash that's sitting in your account right now? And this is not an emergency fund. I mean, in a way it is, but it's really an operational buffer. And there's a difference because when we look at your books and when we look at your profit and loss statement, particularly, you could have a very healthy gross profit margin. You could be extremely profitable and you could be cash poor. And without going too much into accountanese, I will spare you the why behind that, but that is the reality. And we really get into this when you're putting a lot of your expenses on a credit card. because when you put it on a credit card, that's not cash out the door during the month that you spent it. And if you turn around and only pay the minimums on your credit card, you're really not putting any cash out the door except for that minimum. That is a totally different thing than the expenses that are showing up on your profit and loss. And what can happen is if you're turning around and only paying your minimum on the credit card, then pretty soon your credit card runs out of credit and you're screwed. But that's from January's expenses, May's expenses, not what's happening in June. So, in addition to credit cards or debt or loans or whatever capital is coming in, that does not show up on your profit and loss. In addition to that, if you're in accrual-based accounting, you could show revenue because you've invoiced a customer but not get paid. And so the reason I say this isn't an emergency fund is because cash comes down to timing, comes down to when your credit card payment is due if you're using credit cards. It comes down to when your clients are paying you and how often they're paying you. How often are you running payroll or having to buy inventory or whatever it is? All of that is a timing game. So your bank balance could be all over the place depending on what needs to come out today or this week. So that 8 weeks of expenses helps the buffer of the timing. It allows you to make sure you can cover any of that at any given moment and not stress about it. Even though we know you're profitable and it's refilling as it should, it's a timing thing. Great example of this is we have a client who just finished he's a contractor and he just finished helping with Parade of Homes. Is that an everywhere or is that just like a West Coast thing?
I don't know, actually.
If you don't know what Parade of Homes is, they build these very elaborate, crazy, beautiful homes, and then people get to walk through them for, I don't know, a month to get inspiration. It's like Pinterest IRL, right? It's like, I don't know. It's really fun. If you've never done it, the amount of things that you're like, that would be so fun to have in my house. And then you go back and you're like, I actually can't afford groceries. I don't know why I think I could have a cabana at my house, but it's a fun experience to just go through these beautiful homes. Anyways, he's a contractor. And so he had to basically front the cost of these massive, I think he said he did 8 homes, massive projects, the labor, the materials, all of that for 8 massive homes. And then he will get paid for all of that, but not until the contractor decide, after the project is done, then the builder, I guess, is who's paying him,
Yeah.
doesn't pay for anywhere from 30 to 60 days. So he has to cover all of that and then an additional 60 days before that money is going to refill. So it's critical that he has enough cash in the bank to manage that float. And again, it's not an emergency fund because we're not in a crisis. Nothing bad is happening. In fact, he's had more revenue in his first quarter than he's had the last 3 years, but it's a timing issue. Am I making sense? Am I speaking English here? Like, I don't know.
So, but
Okay. As long as Kenzie gets it, then we're covered. It's great. So, again, if the answer is no, again, that's not a crisis, but it's information. And that's something I want all business owners working towards, particularly when timing is a critical factor. Product based businesses, again, we know a product based business that's doing just shy of 10 million. Their inventory bill is real big. Okay. And then they have a lot of payroll and they've got a lot going on. Marketing is outrageous. You wouldn't even believe. And they don't get paid for that product until they sell it, obviously. But they've had to purchase it up front. So again, timing is just such a critical
yep.
factor when it comes to cash.
Yeah. I also think too, like with service-based businesses, like if a client decides to leave or you lose a client or things like that, like that's another thing where you're like, I have this revenue, and then all of a sudden I don't, but you still have people to pay and a business to run, like that kind of fund helps in those instances. So if for whatever reason you lose a client, you're not stressed because you're like, I got to bring in money right now. You're like, actually, I have a month or 2 if I needed to help
Yes.
cover that gap while I go and find another client or change my strategy or whatever. So,
Correct. Yep. I love it. Okay. You want to take number 4, Kens? I've been doing a lot of talking.
yeah, yeah. So, number 4, and this is kind of a fun one that you wanna look at, is accounts receivable aging. So, what does that mean? What is that number, right? Your accounts receivable is how much money you're owed right now, okay? And I'm interested to know how many people are looking at that number often.
Yeah.
Because we have had multiple clients come in that we pull their accounts receivable aging report, and there's stuff on there that's been there for 180 days, over 180 days. And it makes my stomach hurt a little bit. So what is normal, right? So 0 to 30 days, normal numbers to have in accounts receivable. That's pretty typical, that's pretty standard. Clients will have money in there because of how their customers pay, right?
Yeah.
31 to 60 days, we're wanting to follow up on
Mhm.
those clients. We want that money in the door. Why are they not paying? Is it an issue? And if we don't follow up, that client is never going to like push it, right? Nobody
Yeah.
wants to pay a bill. I never
Right.
want to pay a bill, but I have
Right.
to, right? Like
Right.
if I'm getting a service, I have to pay my bill. So lots of times, like if we're not following up, that money will just continue to sit there and sit there and sit there. And it's never going to come into your bank account, right? 31 to 60 days, we're following up, right? We're saying, hey, here's your money. Or sorry, hey, here's your invoice. It hasn't been paid yet. Can you give us an update? When are we going to see that money? 60 plus days, we're starting to talk about collections. What are
Yes.
we going to do to collect that money? 60 days really is kind of
Too
that
long.
point. It's too long. We've done the
Too
service.
long.
If it's a service based business, an accounts receivable is really most often tied to a service based business. Occasionally, product based businesses will have that, but like very rarely do we see that unless maybe it's like a wholesale situation.
Right.
But with service-based businesses, like 60 days have gone past, you have probably already performed the services that they need to be paying for. And if they're 60 days overdue, it's likely that they've also got one in 60, one in 31 to 60, and one in 0 to 30, because we're now 2 months past when the services started, right?
And I love credit to this client of ours who I very rarely give credit to, and I should. But she used to always say, "I'm not a bank." And I loved that because it changes your perspective. You are fully lending them that money at
Yep.
this point, interest free.
Yep. And you did
You
a
are
free
fully
service for them.
lending them that money.
Yep.
And I don't know a single bank that lends people money, first of all, without a credit check, but second of all, without
Interest.
major interest and penalties if they default, right? Like if they don't pay you on time, you are fully lending them money. And most small business owners don't have a lot of money to just throw at a customer to let them dine
Yeah.
out on, you know?
Yep. Yep. Exactly. And I don't know how many time and time again that we have seen clients come to us and they're like, I just don't have money in the bank. Like I'm billing people, but like I don't have money in the bank. I'm confused. And the first place we go is their accounts receivable. And we go, well, you have $50,000 sitting in 60 and over.
Yeah.
Like, that's
Yeah.
why. And we have Becca is our resident AR specialist. She's salt of the earth, amazing, will get that money for our clients no matter what. She has the cutest little face, but she is like a bulldog. If they
Yes.
are owed money, she will get it for you. Shout out, Becca. We miss you. Can't wait till you come back. Enjoy that little baby.
We're
But
on day 3 of maternity leave and we're really sad.
only drowning. It's fine. We
It's
love
fine.
her, and she'll be back forever one day. But truly, like if you are not looking at your accounts receivable and seeing what money is left out there, you could have $20,000 to $50,000 sitting that you need to collect on. And if somebody isn't following up, and if you're not going after that money, you're basically just giving your customers a loan.
Yes.
And most businesses can't do that.
Yeah.
They just
Just yesterday, and you'll know this, but I was doing a cleanup project for a client and they're like, "Yeah, like things are tight. We can't really afford like ongoing services with you guys," and which is fine, no big deal. So like, "Will you just help us with a cleanup?" And it's just sad because one, obviously I feel like I could do so much good to help them, but two, I literally wrote off 20% of their annual revenue last year. I had to just, they were like, "We're not going to be able to collect that." And it's because it's literally a year after the fact. There's nothing like every day that goes by, the less likely you are to collect every day that's overdue. And it's been a year for them. And so we had to write it off 20%. That would pay my bill, just so you guys know, that would pay my bill for like the next, I don't know, 10 years, how much
yeah,
I wrote off for them.
yeah.
And it's just sad that they're like, they can't get the help they need because they didn't watch their AR. Like this, we're not just talking inconvenience. This like can make or break your business.
Yeah. And the crappy thing too is that they already performed the service. They
Uh-huh.
provided a service to these customers and they didn't pay. They did not get paid for the hard work that they did. And that makes my blood boil because it's not fair. It's not fair to these people that go and do a service and then they don't collect the money. But like
Yes.
Joey said, a year is too late. And you're right. You can't do it. And there are going to be times where it's like the business like ran out of money, right? And they went bankrupt or something. And like, yeah, you're never going to collect that money. But like, there are times where it's like if you were following up constantly and you're like, hey, if you don't do this, you're going to go to collections. That
Yeah,
scares businesses because that doesn't look good
for
for a business
sure.
if you have to
Yeah.
go to collections. And so
Right.
they'll either pay or you'll send them to collections and you'll get to at least recuperate some of that money. You know what I mean?
Right. Right.
And so but if you've waited a year, it's too long. It has to be done in those first 30, 60, 90 days.
At the latest, for
90
sure.
days, you're sending them to collections. You send them a notice and you say, sorry, you haven't paid. We're sending you to collections. And very often you will get a call from that client almost the next day because they don't want to be sent to collections and they'll either try and set up a payment plan or they will try and cover their bill. But if you are just kind of like, it's fine, you're going to lose out on that money and you've done work that you should have got paid for that you did.
For sure. And just side note here, collections is expensive for you. You will get a fraction of what you actually should get. So you want to avoid that if at all possible. Setting up automatic reminders is take that step if you do nothing else. Take
Yeah.
that step. There's
Yeah.
so many ways to do it. Usually in your invoicing system, it will allow you to send reminders. Critical that you have good bookkeeping if you're sending reminders, particularly out of QuickBooks, because that's how it closes the invoice out and you don't want your clients getting reminders for paid invoices. That's a whole other topic, but it's not enough. You really need to like keep your eyes on it. But again, if you do nothing else, if you need a step one, start there. Okay, step number 5, and this is probably my favorite and also the hardest number for me to like, this is my scary number. This is the number that like I have a hard time sitting down and being like, are we on track or are we not? Because I have big goals. And that is owner's comp versus what you anticipated. And it's because it's personal, I think, and because as business owners, we are constantly at war with ourselves around I'm charging too much and I'm not making enough money from how hard I'm working. I think there's a constant internal battle because we want to help people. We love what we do. We want to be able to do it for free. And also, at the end of every day, we're exhausted from putting our whole heart and soul into this for days and months and years. And if we're not making enough money to justify that, it's easy to experience burnout. And it's a constant back and forth. And I think this is really where the emotion comes up for me because I'm like, well, do I deserve to get paid that much? But then on the next day, I'm like, dang, I've been working really hard for a lot of years to get paid, that number. Right. And
And
so I
I
think we skip it for that reason.
Yes, and I think, like, as a business owner, it feels almost, like, selfish a little bit as an owner to be like, "Oh, I'm gonna take X amount of dollars back from my business." You know what I mean? And it's like,
Right.
it feels selfish, and nobody wants to feel like they're being selfish, but I think it's
Yes.
sometimes hard, like, as a business owner to be like, "I worked really hard," because you have to be a little bit selfish, and you
Here's
have
my deal. I've
like
seen when I separate myself from it and I look at the people we work with, which usually helps me be a little more rational. If Tracy were to go get a job, I don't know, Tracy Turnbad from
yeah,
Hairspray.
or what?
If she were to go, that's a bad example, but if she were to go get a job in this same field at a similar company, would she be making the same, less, or more? And if the answer is more, the temptation to burn it down and go get a day job will constantly live in the back of her mind. And when I bring it back to myself, if I constantly have one foot out the door, because I could make more money getting a day job and working less. Because remember, as owners, we never clock out. And so if the temptation of just a 9 to 5 is so real all the time, especially if I'm going to make more money doing that, it's like, that's a no brainer. If I constantly have one foot out the door, it's going to be really hard to give it my all the time. It's going to be really hard not to burn out. We have had so many seasons of burnout during this business. And every time a job opportunity pops up on LinkedIn, you're going to be like
Should I do
thinking
it?
about it.
Yeah. Yep.
And that's not fair to the 20 kids whose mouths you're feeding because of this business. And I don't say that to be like, look at what we've done by any means, but because it's so easy to be like, well, owners eat last and I've got to reinvest. It's way easier to lean that direction. I think it's important that you have to like remember what you're doing and for who, even if it's your own family, even if it's your own kids and it's nobody else. In the early days, it was our 6 kids between us. Really, it was like 4 at the time when we started. Those 4 mouths are depending on you doing what you love and building something great. And now it's grown to more than that. And I hope in the next 5 years, it does way more than that. And so when I think about those people and what we're doing it for, it's not fair for me to have one foot out and looking at another job. You have to be making what you would be making at a day job, if not significantly more. And honestly, and I truly believe this, you deserve it. And so even if it's not plausible at the beginning, like there's no reason you should not be making a CEO salary or a COO salary if that is the job that you're doing. And that's fair. And there's literally nothing wrong with that. And that takes a lot of unwinding for me. But I'm saying it to you. I'm saying it to me. I'm saying it to everybody. We need to remember that, like, we are worth it. We have worked hard for this. And there's no reason that my kids shouldn't be able to get a pair of freaking glasses if they need a pair of freaking glasses because they sacrificed time with me because I was working on the business. So the hard part is owner's comp is the first thing you cut when cash is tight. And I actually do believe in that. I do think I subscribe to the Simon Sinek owners eat last thing. So again, let's back this up and say this is just a data point for us. Are we paying ourselves what we said we would pay ourselves in June? If the answer is no, it feels like a gut punch. But the reality is that we just need to say, okay, so what factors do we need to look at and change in order to make that answer a yes? That's all it needs to be, right? Is what do we need to change? Do we need to raise prices? Do we need to look at our margins? Do we need to cut marketing budget? Do we need to, whatever it is, there's a million things that we can change in order to get this number back on track. It's just information. That's all it needs to be. Obviously, I needed this piece of the podcast for myself. And Kenzie's like, actually, we do need to have this conversation. But yeah, it's just information. Are you paying yourself what you said you would pay yourself? And if the answer is no, then what are we going to change? What are we going to do about it? I don't know. What do you think, Kenz? Because in our business, I really do a lot of the financial pieces of our business because Kenzie's so busy doing literally everything else. And so we don't sit down. I mean, you know the numbers. It's not like they're secret by any means, but it's not common for us to sit down and be like, okay, like what are we going to change? Usually I'm kind of going, hey, I think we should do this. And Kenzie, as an amazing business partner, goes, yeah, that sounds fine, whatever. So how does the idea of sitting down and like talking about owner's comp and like looking at those numbers, what comes up for you? Because for me, it feels very vulnerable and scary.
Yeah, it does. And I think, like I said, like, I think sometimes I look at it and I'm like, am I being selfish? Like, you know what I mean? Like, sometimes I think it's like you want to be like, oh, well, like, I'm making more than like my employees or this or
Yes,
that. And you're like, are they going to be mad at me? Are they going to like, which, like, they would never know because that's not their job to know, and they shouldn't know, like, all of those
sure.
things, but, like, I think, like, internally, you're like, "I want it to be fair, and I want people to love me, and I want people to, like, work well and, like, get paid for what they do," and so, like, in the same breath, I'm like, "Okay, like, they should get paid and compensated for the work that they're doing fairly, right?" And, like, I
Yes.
think it's like, yeah, you should too. You're
Yeah.
working too. You're running a business, you
Why
know?
is that so hard? We need a manager to be like, here's your
It really
raise because
is, and
it's
I
so
think it's
hard.
like, and I think sometimes too, like, I think it's hard to see, like, look inward and be like, "I am valuable, I do bring a lot to the table." Like, it's really easy for me to go, "Joey's amazing, she does all of our sales and marketing, she does all of our financial stuff, she runs payroll for the company." And also she's, like, answering all of these questions, and so it's really easy for me to, like, look outward and be like, "Yeah, Joey does deserve that owner's comp. That's what she should be making. In fact, she probably should be making double that." You know what I mean? And it's really easy that way to do that, and I think sometimes it's hard as a business owner to, like, look inward and realize your value, especially if, like, maybe the business isn't going how you want or, like, things like that, like, it's really easy to be like, "I'm a failure, I don't deserve a dime," you know?
Yes.
And it's like, "I shouldn't make this money," but I have also learned in running a business with you and putting this together that, like, it's important that we get paid a good amount that we should be making. Otherwise, the burnout is real. And like you said, it's really, really easy to be like, I'm not really gonna work on this. I'm not gonna better this because I'm not making enough money, you know? And it's twofold. I have never felt like that in the times that I've worked for this
I mean,
business.
I have, but
But like in a way that like I I want to grow this business so that I can make more money and also have more freedom. And so like, you could pay me $100 and I'd be like, "Let's do this." You know what I mean? And but it's also one of those things where it's like you have to also take care of your family. And I like you can't deplete owner as an owner, you can't totally deplete yourself and put all of your stuff into your business and not get paid for it because at the end of the day you do have a family at home that you have to take care of and you have to be compensated for the work that you're doing so that you can take care of your family and do the things that you love. Maybe you don't have a husband or maybe you're not married or maybe you don't have kids or whatever, but maybe you want to travel and you really want to go to Italy one day. And like if you are pouring everything into your business and not getting paid for it, that's not fair. And it's not going to make you a better business owner.
yeah. The
I don't know if
saying is
that
money
makes
is mission, right?
but
Like whatever it is that you're passionate about, whatever your why is behind this, whether you want more women in accounting or you want freedoms to take care of your kids and be available to them, whether you want to go to Disneyland, whether it doesn't matter what your why is, what your mission is, money is going to fuel that and allow you to do more of it. And a lot of that comes with owner's comp. It just does. That's
yeah,
just the reality of it. So
yeah, yeah,
anyways, enough on that. We're gonna have our own owner's comp conversation, I think. After this podcast, we learned something for ourselves. Yay. Okay, so we've got our 5 numbers. That's what I want you to do when you sit down, hopefully this month, and you decide to have a strategic talk with yourself or with your team or whatever it is. Those are the 5 numbers that I want you to look at. But I want you to remember as you're looking at these numbers that this isn't necessarily a report card. It certainly doesn't need to mean anything other than these are stats in the stat book, and they are just designed to give you information about how to execute a strategy. What strategy should you use, and how are you going to execute it? That's all it is. They're just signals, they're not verdicts. So, 3 moves: celebrate what's working, diagnose what's off, and make one decision before you close the laptop. I actually really don't want you changing 5 things right now. That will
no,
be completely ineffective.
too
Make
much.
one.
Yep, yeah,
One decision. And that advice is for me as much as it is for you because I'm big into overhauling the entire business. And I'm telling you, been there, done that. And it actually makes you lose so much traction. So don't do it. So, whatever number is going to move the needle the most in the next 90 days, that's the number I want you to focus on. And that's it. Those are the 3 things that I want you to do: celebrate the wins, diagnose what's off, and by how much. 90% of the magic is writing down the actual number and then make one decision around one of those numbers that you're going to fix in the next 90 days.
yep. And then not only that, but I want you to block out time to, like, implement that
Yes.
thing. If whatever it is, right? Whatever you want to do, whether it's like, I'm gonna do more marketing or I'm gonna do this or that, like, you have to block out time to work on those things. Otherwise, you'll just write it on your board and never look at it again, right?
So true.
So Joey and I have implemented, we have an executive meeting that is a stand-up meeting that we have every Monday. And it's like 2 hours, I think. And that is when we work on the business as business owners, right? Like sometimes we have to do what need to be implemented, things that need to be changed. So I want you guys as a business owner, once you look at those numbers and you diagnose the problem and you figure out the one thing that you want to change for the second half of the game, block out time in your calendar. It doesn't have to be every week. It might not need to be every week, depending on what you're choosing to change. But block out time once a month, once a week, every other week, whatever it is, to implement and work on that thing. because if you don't, you'll write down your goal and then you'll never look at it again.
I love it. I love it. Okay. 5 numbers again, really quickly for everybody. Number 1 is your revenue versus your revenue goal, gross profit margin, cash on hand versus 8 weeks of expenses, accounts receivable aging, and owner's comp versus your goals. Those are the 5 numbers I want you to check. Take 30 minutes to get it done. Like Kenzie said, block it out in your calendar. That is sacred time. That is going to move the needle more than any sales call, any activity that you do. That is going to really, really help. So make it a priority. And if this was helpful, literally all month long, we're talking about this. We have tons of content on Instagram, TikTok, Substack, and LinkedIn. So feel free to follow along to make sure that your halftime is as effective as it can possibly be. And that's what we got for you today. So, Sharon, thanks for being here. Thanks
Thanks
for
for
listening to us ramble.
all the listeners. We hope your second half is even better,
Agreed.
and we're excited to be along on the ride with everyone.
Love it. Thanks again.